Okay, class, this is part 2 of our Chapter 3 video lecture. I'm rearranging the slides in the PowerPoint show to be pretty much in the order you see here for the income items listed on the 1040 form. So the first item, of course, is your wage or salaries that's reported to the taxpayer in Form W-2. And here's a sample W-2 where we would add up all the amounts in boxes 1 of the different W-2s, including the spouse's W-2s if this is going to be a joint return, and then rewrite it in that line 7 of the 1040 form. Hopefully you've had enough federal income taxes withheld to not pay any big taxes due at the end of the year. Now, usually whatever is reported here in box 1 also is going to be reported down here in box 16 for the Hawaii or state wages. Most times it's the same amount as box 1. So let's say that you're a federal civil service employee here in Hawaii or maybe even Alaska, and you get something called cost of living allowance. That additional income is not taxable here for federal purposes. But Hawaii is different. Hawaii says your COLA allowance is going to be taxable, so you have to add that in for the Hawaii wages. Or let's say that you're a city and county or state employee and you contribute to the pension plan. They call it the employee retirement system. And they take that out of your paycheck, and for federal purposes, they're going to reduce your gross pay here to be, that's going to be a smaller amount to be taxed. Whereas Hawaii says, no, we're going to keep that amount in that they took out and tax you now. But later on, when you start to collect your pension from the ERS, it's going to be state tax free, although it's going to be taxable for federal purposes. So that's W-2 income. Let's take a look at the next type. Interest income. Basically, you're depositing money with a savings account or checking account or certificate of deposit with a bank, savings and loan, or credit union. Credit unions call their interest dividends, but it's interest income for tax purposes. Or some life insurance paid dividends and interest. It's interest that's taxable from a life insurance policy. Or if you sell property and you own the mortgage to whoever bought the property, that would be interest income. And sometimes they call that an agreement of sale or contract deed. Or you buy bonds from a corporation or from the government. Well, corporate bonds, the interest is taxable. Municipal bonds, bonds you buy from states, cities, counties, municipalities, um, agencies like the airport or port authorities are tax-free, tax-exempt. Sometimes they call this municipal bonds, muni bonds, and interest on that is tax-exempt. Generally, there's always exceptions. Um, Savings bond interest. Well, U.S. government bond interest is taxable. It's the municipal bond interest that's tax-free, right? Now, if you buy savings bonds from the federal government, it may be possible to exclude interest if you use the bonds to pay qualifying education costs. I've never seen that in my whole career, but it is a possibility. So here we use Form 1099 to report interest income to the taxpayer. Here the recipient. And here's the financial institution's information. So here's the interest income being reported. If you receive more than $1,500 of interest income for the year, you have to itemize it out on a Schedule B, Part 1. So here's the name of the payer and the amount. Name of the payer and the amount, and a subtotal. And again, if one of these is savings bond interest and you use the proceeds for education, qualified education costs, you may be able to exclude part of that interest income. That's calculated on Form 8815. and then the net amount of interest income is then reported back on the 1040 form. Let me go back to the 1040 form again. Here in line 8A. Even if your interest is less than 1500, you still got to report the total here. It's when it's more than 1500 you have to fill out that Schedule B. You also have to report tax-exempt interest, that municipal interest here in box 8B. Even though it's not added in with the other income and paid tax on this income, this is still disclosed, and we'll see why later on. That tax-free interest is reported, sorry, that's W2. Here's the 1099 INT reported here. Included in this tax-exempt interest may be something called private activity bond interest that is subject to a tax called alternate minimum tax, AMT, that we'll see in our last chapter, I believe, of the semester. Let's move on to the next type of income. That's receiving money as a distribution from a corporation, or dividend income. Depending upon who is the shareholder receiving this dividend, if the shareholder is another corporation receiving the dividend, then they can exclude or deduct something between 70 to 100% of that dividend. They call that a dividend received deduction. And you'll learn more about this in the next tax class next semester. Our class is Business Administration 319, focusing on individual taxation. The next tax class is Business Administration 419, focusing on partnerships and corporations. Okay, so corporations, if they receive dividends from other corporations, can deduct this dividend received deduction. That may vary in the percentage here based upon how much they own of the paying corporation. We're focusing on individual taxpayers. So our individual taxpayers receiving a dividend, and what we call qualified dividends are going to be taxed at a lower rate. Depends upon the other income they have and what's the marginal tax rate of that taxpayer. This qualifying dividend is usually paid by U.S. companies, not foreign companies. There's also something called capital gain distributions paid by not really corporations but mutual funds. So let's say you're interested in investing, and one of the rules of investing is to diversify. To be able to buy lots of different stocks, you need lots of money, right? Well, what you would like to do is really diversify by investing in a mutual fund, or something called an exchange traded fund. So the typical investment is a corporation owned by a shareholder. So let's say you buy shares of stock in this corporation, and if the corporation is profitable enough, it'll distribute out some of that profits as a dividend, issuing out a 1099. And if you want more diversification, you have to buy more corporations, right? More shares of stock, hopefully in different industries, different sectors. But to diversify and you don't have enough money, what you should, as a shareholder, buy is not into a one corporation, but into, let me call it, exchange traded fund or mutual fund, where this mutual fund or exchange traded fund will buy shares of stocks in lots of different companies for you. Of course, there's other shareholders too, right, besides you in this exchange traded fund. And the philosophy of investing here by the fund depends upon its goals in terms of, let's say, mirroring the market, maybe buying just big companies or middle-sized companies, or certain sectors like healthcare or foreign companies. And these corporations down here may be paying dividends, not directly to you, the shareholder of the exchange traded fund, but to the exchange traded fund. And by law, to maintain that mutual fund or exchange trade fund status, they have to pass on their dividends to you now. And you got to report that as dividend income. But most shareholders up here will tell the mutual fund or exchange traded fund to keep the money and buy me some more shares of the exchange traded fund. Even though you don't see the dividend money because it's reinvested, you still got to report that as dividend income and pay taxes on that. Of course, now the cost you reinvest can be added to the total cost basis of your investment in that exchange traded fund. And eventually, when you do sell shares of this ETF, or if you do what they call dividend reinvestment here, a DRIP, you have a bigger cost basis resulting in a smaller gain when you sell that underlying stock or underlying exchange traded fund. Now, keep in mind, if this is managed here, this ETF is managing their investments, they may buy or sell corporations down here. And if they sell a corporation stock, there may be a gain or loss. Gains have to be distributed as dividends, as capital gain distributions after netting out any losses here. So this is going to be taxed to the shareholder. And that's what this is here, capital gain distributions, just like dividend income, possibly even taxed the same way at lower tax rates. So here's a 1099 DIV sent to the recipient, our taxpayer, from that corporation or exchange traded fund or mutual fund. Here's the total ordinary dividends, and within here are the qualified dividends that are going to be taxed at lower rates. Okay, so this number is already included in here. Yeah, it's duplicated. This number is either equal to or greater than this number over here. And here's that capital gain distribution I mentioned if it's a mutual fund or exchange traded fund selling the underlying stock. There's other types of gains or losses that we'll talk about in future chapters. So if you have more than 1500 of interest income, you would have itemized it up here in part 1. If you have more than 1500 of dividend income, you can now itemize it here in part 2 of Schedule B. The name of the company and the amount of the dividend. Name of the company, amount of the dividend. The total. They call this ordinary dividend, which again includes the qualified dividend. Let me go back to that, do I have one here? The 1040 form. So here is the ordinary dividend, and inside of that ordinary dividend amount is the qualified dividend that will get taxed at lower rates. Okay, this is inside of here. This municipal muni bond interest is not in this interest income area, even though it kind of mirrors it, the lines here. Okay, so the tax rates that the qualified dividends get taxed at are these lower rates. So if your regular marginal rate is in the low 10% or 15% bracket, those first two rows of the tax rate schedule, which I'll show you in a second, you're going to take out those dividends from the taxable income and tax them at zero, no tax. And the rest of the income of the taxpayer is taxed at the 10 and 15% rate, probably using the tax tables, yeah? And then if our taxpayer's marginal rate is from 25 to 35%, we take out the qualified dividends and tax them at a relatively lower rate of 15%, and the rest of the income is taxed at the regular rates. Or if you're in the highest tax bracket, almost 40%, your qualified dividends are not going to be taxed at this rate. We take it out and tax it at 20%, and the rest of the income is taxed at the regular rates they fall in. So here is a tax rate schedule for the single filing status. So again, if your taxable income, that's the total income minus the deductions, falls within these areas here, let's say this first two brackets, your dividend rate for your tax rate for qualified dividends is going to be 0%. You take out the qualified dividends from your taxable income, and whatever is left over, you tax at the regular rates. Okay. And then if your uh, taxable income falls within this range, 25 to 35%, you take out the qualified dividends from your taxable income and you tax it at 15%. Or if your total taxable income that includes qualified dividends is over this amount, you take out the qualified dividends and you tax them at 20%. And the rest of the income is taxed at these other rates here. Okay, so it's always nice to have qualified dividends no matter what rate you fall in. But if you're in the lowest two brackets and you have qualified dividends, zero tax on those dividends. All of this calculations on the tax on the qualified dividends and other income is done on a worksheet that is used for both qualified dividends and the net long-term capital gains that we'll talk about in a future chapter. This worksheet is inside of the instructions for the 1040 form. Our textbook talks about, let's say if you're audited, the IRS is going to say, hey, you're missing some dividend income being paid out or constructively paid by the corporation. So let's say we have a shareholder who's also an employee of a corporation. Okay, so maybe this shareholder is the president or the CEO, and they get paid a salary or wage. And of course, they pay taxes on that. But the corporation will get a deduction for this payment and reduce the corporation's tax. If the shareholder employee doesn't really do that much compared to other employees, compared to other companies' presidents or CEOs, maybe this salary is unreasonable. And what they're saying is maybe we got to reduce that salary, and that extra that this person got paid is really a dividend that is subject to tax like we just saw in the previous slides. But a corporation, when it pays a dividend, unlike paying a salary, they cannot take a deduction. It doesn't reduce the tax of the corporation when the corporation pays a dividend. Typically, this will come out if you're audited. Another situation is if maybe this person here is using the airplane, the jet, the yacht of the corporation and not paying anything for that, not reporting it as income. Then a constructive dividend may be charged to that owner, the shareholder, and they got to report income. The next type of income, the most common situation is receiving a state, not federal, a state income tax refund. So let's look at this example where Cindy is paying $1,000 in state taxes in 2016, and that's through her paycheck, yeah, as a withholding. And she's going to deduct that $1,000 on an itemized deduction schedule A. Remember, we have the choice of either itemizing or reporting the standard deduction, and she is itemizing. So that's going to be reported on her 2016 return. It's going to reduce her taxes by claiming this deduction. When she filed her 2016 state tax return, this is going to be in the following year, she is going to get back now $200 of that $1,000 she had paid. She paid extra state taxes, so the state is going to pay her a refund of $200. So the rule here of recovering a previously deducted amount, she's recovering $200 of a previously deducted $1,000, is now that $200 is going to be reported income when she receives it in the following year. The reason why is that $200 is included in this $1,000 that she deducted, and she reduced her taxes. When you recover part of this, you got to report it as income. It's fair, right? You got a benefit of reducing your taxes, and if you get back that deduction, now you got to report it as income and pay taxes on this. Let me illustrate this again. This doesn't just apply to state income tax, but to anything that you get to deduct and recover later on. So in the case of Cindy, she has 2016 let's talk both federal tax return and we'll call it Hawaii tax return. She has income to report, like her wages, maybe other income. Then she takes deductions, right? Both on both returns, federal and state. She deducts itemized deductions. And we'll do the same thing here in Hawaii, itemized. And included as one of those itemized deductions is the $1,000 state income taxes that were withheld from her paycheck. Here I'll call it withholding. And then she has some other deductions like exemptions, maybe even business deductions to get eventually her taxable income. Yeah, her taxable income. Then we figure out the tax. I'll just continue with the Hawaii one now. And you see this withholdings here? That's going to reduce her taxes she owes. And she ends up with a $200 refund. And she's going to collect this refund the next year, the year she files the return for 2016, here in 2017. And for her federal and probably the state return, her income has to include that $200 because she deducted that 200 inside of this 1,000 in the previous year. Sometimes we call this the tax benefit theory. We got a benefit of all of this 1,000, and if you recover it, here she recovered 200 in the subsequent period, the subsequent year, you got to report it as income. Okay. Now, instead, if she had deducted not itemized but standard deduction and still got back a $200 refund, let's do that for federal to standard deduction, and she gets back the $200 the next year, you don't report that as income because she didn't deduct the state income taxes. So some people would claim not state income taxes, but maybe the sales tax deduction instead, which is an option, or the standard deduction and not itemized. Thus, any state refund is non-taxable. Let's say you have a federal refund down here. Federal refunds you receive, of course, in the following year, 2017, are never taxable because you never deducted it in the first place. You may have reduced your tax like here we did here, but you didn't use it as a deduction. You have a prepayment or a credit, yeah, when you pay the federal tax. Any excess you get back non-taxable, unlike a possible state refund. Okay, so that's recovery of previously deducted amounts. That's reported to our taxpayer on a Form 1099-G, G for government, and here's your refund. Next type of income is receiving money from your ex-spouse. So here's one ex-spouse paying money to the other ex-spouse. So there's three different possibilities of payments. The one that we are focusing on is alimony. And the paying ex-spouse gets to deduct that on his or her tax return. And the receiving ex-spouse has to report that as taxable income. Now, if instead, let's jump down to this last one. The paying spouse is paying not alimony, but child support to this ex that's taking care of the custodial parent, yeah? That child support you cannot deduct. Receiving child support, not taxable, unlike the alimony. So you can see some maybe negotiation. Oh, I'll take more now child support than alimony, yeah, because it's non-taxable. But the person paying it wants to pay more alimony versus child support. Unless maybe we can claim the child, the paying spouse, claim the child as a dependent. The general rule is that the custodial parent, probably this parent here that's receiving the child support, can claim the child's dependent exemption and probably the child tax credit. But in lieu of receiving more child support, maybe this custodial parent is willing to give up the exemption, the dependent exemption to the other spouse, other ex-spouse. property settlements is less of a payment and more of a division of property the taxpayers own at the time of divorce. And there is generally no immediate tax effect. But you got to be careful here of what type of assets you claim, yeah, in the settlement. Let's say that this spouse is giving the retirement account he or she has to the ex. At that point, there's nothing to tax. But when that ex-spouse starts to collect on that retirement account, there's probably taxes that have to be reported. Just like if this employee spouse received that retirement income. Or let's say we're talking cash. Cash, definitely say $1 million of cash, yeah? And how about a $1 million house, $1 million home? What would you take? The cash or the home? 50-50 split, right? $1 million, $1 million. Well, it depends. How much is the cost basis of this home? Because eventually, when you sell it, you get to deduct only the cost basis. And the difference will possibly be a taxable gain unless you have that exclusion. Yeah, I mentioned before of that 250 or $500,000 amount. Cash basis of the cash you receive is the same as the face value. Yeah, nothing to report when you spend the money. Be careful how you do all of this when you get divorced. Yeah, hopefully not get divorced. To be able to claim alimony, the amount has to be in cash or payments in lieu of cash, has to be because of divorce, has to be in writing, the divorce decree, has to stop when the recipient dies, has to be clearly stated as alimony in the agreement. And the people that are ex-spouses cannot live in the same home. So let's illustrate alimony. So here's the taxpayer and their social security number. And if you're paying the alimony, you get to deduct it over here as an adjustment, yeah, for AGI. And you got to write down the social security number of the spouse. Now, if you're receiving this alimony, you got to report it here in line 11. Of course, the IRS probably knows that your ex is taking a deduction and reported your number. So when you report your number, they expect you to report this amount of income, yeah, on your tax return as a cross-reference. Next type of income, business income. So if you're a business receiving money from another business, you're receiving this type of income here. You're not an employee, non-employee compensation. Now, if you were employee receiving money from a business, you would receive a W-2 form. Something similar to this 1099 miscellaneous form is a 1099K, something relatively new. People that drive for Uber, possibly Airbnb rental, that process fees through credit card companies, maybe eBay, their income is reported here. And the IRS now has a record of that, has to be reported on their tax return. So if you have a business, a sole proprietorship, a single proprietorship, you would first report the income on a Schedule C before reporting it on the 1040 form. So here's the gross income you've earned for the whole year, including those amounts reported on the 1099 miscellaneous and 1099K. What you do get to deduct is the cost of goods sold right here. So if you remember in your previous accounting classes, beginning inventory, remember that? Plus purchases minus the ending inventory equals the cost of goods sold that you get to subtract here to get the gross income figure. This is one of the few deductions you get to subtract to get to gross income. Now there's a lot of other deductions mentioned below here, but that's not at the gross income level, yeah? Cost of goods sold is a deduction to get to gross income. This is the gross fees, gross sales, gross receipts you've charged or collected. Gains on the sale of property. So if you have an investment with a broker, The broker is going to issue out a Form 1099-B showing you when you bought the item, when you sold it, how much you got, how much you paid for it. The difference between these two amounts is the gain or loss, whether it's short-term or long-term and other factors here. Another form used to report big sales in real estate is a 1099-S. Basically just the proceeds, the sales price, yeah? None of the cost is here. In all of these cases, though, eventually the gain or loss is reported on a Schedule D before re-reported as a net gain or loss on the 1040 form. So here again is the proceeds minus the cost to get the gain or loss, be it short-term or long-term. You may need to even give more detail on this form 8949 that we'll see in a future chapter. Retirement income. So here's the total you got from this paying company, and here's how much you say is taxable. So what we're looking at is pension plans, profit sharing plans, 401k, 403b, IRAs, traditional or Roth. I'm missing something here. There's probably some others, yeah? Again, a 1099-R, and here's the amount that's going to be taxable. You're a landlord collecting rent. Here it says that if you collect also a security deposit, that's not income, at least yet, because you have to determine whether you're going to keep that versus refunding it. At the time you determine you're going to keep it, be it the last month's rent or be it because of damages, at that point it now becomes income. Again, even though you're keeping the money because of damages, and that is income to you at that point. Now, of course, you're going to spend it and possibly get to deduct the cost of the repairs or replacement. But the security deposit eventually you do keep, be it for rent or be it for damages. At that future point, it becomes income. If you pay, if the tenant makes improvements to the property and the landlord keeps those improvements, it's not considered to be rent to the landlord. That's not a common situation. Typically, the common situation is the landlord to make it to motivate the tenant to move in. So they're the ones that are going to improve the property, set up counters, put in electrical for my equipment, maybe even give me a rent holiday for a couple months, unpaid rent. Well, even though I don't pay rent as a tenant, it's not income because I would have to actually pay them back, right? The rent. They give me money, income. I pay it back to them, expense. So it just cancels out each other's. Any improvements the landlord makes, it's their property. I'm just renting it from them, so it's not income to me. If you're one business paying rent to another business, you may be reporting rent income to the recipient on a 1099 miscellaneous form. The same one we saw for the non-employee compensation. If you're a residential tenant, a person like you or me paying a landlord, a business, you wouldn't issue out one of this, right? Because you're not a business, at least for purposes of renting out that space. Rental income is reported first on Schedule E before rewritten on the 1040 form. Here you can see there's room for at least 3 properties on one Schedule E, where the rent for the 3 properties is reported here and the expenses reported down below, which you subtract to get the net rental income or loss. We'll see problems or issues in terms of losses in future chapters for rental income or rental property. If you don't pay back a loan you owe, the forgiveness or the uncollecting amount may be income to the person who had borrowed, the so-called debtor. There are exceptions for this to be tax-free, like if the borrower is in bankruptcy or insolvent, or if it was a mortgage on their personal residence under probably 2016, I'm not sure 2017 laws yet. That could be tax-free. They call it cancellation of debt income. pass-through incomes. If you're a partner in a partnership, a beneficiary of an estate, this is income of a respect of a decedent, or a beneficiary of a trust, or a shareholder of a S corporation, then probably you're going to get a form from those entities called a Schedule K1. In this case, it's a partnership. And it kind of looks like a W-2 form showing your share of the income and deductions and maybe tax credits you got to report on your 1040 form. Some of these items may be reported on the Schedule E, page 2. If you get gambling winnings, here you went to Vegas, and here's the amount you got to report. Now, what did you bet on, or what type of gambling? Probably this, yeah? Or Keno, or Blackjack, Roulette. Unemployment pay, here. Hopefully, if you had taxes withheld so you don't owe anything when you file your tax return. The calculation of what's taxable for Social Security benefits is kind of summarized here. It's not a real good calculation in this slide, but basically you would start off with the taxpayer's adjusted gross income before adding in any taxable Social Security. Then you add in the tax-exempt municipal interest income. Here's where it comes into play. This interest is not taxable by itself, but it's added to the Social Security calculation to possibly make Social Security taxable. And we've talked about the foreign earned income exclusion that has to be added in. And here you're adding in half of the Social Security benefits to get something called provisional income. And if your provisional income is less than $25,000 if you're single or head of household, then none of your Social Security benefits are taxable. But if it falls within this range, up to half of the Social Security benefits, here half of the benefits could be taxable. And if your provisional income is over these two ranges here, the other range being married, filing joint, then 85% possibly of your Social Security benefits are going to be taxable. The detailed calculation of what's taxable for Social Security benefits is done on this worksheet that's included in the 1040 instructions. Here's what the taxpayer would receive: a form, let's see, SSA 1099, and here in box, I believe 5 is what you would put in as the benefits received for the whole year. And you go through that calculation to figure out how much of it is taxable. Last couple slides here. If you receive insurance proceeds, life insurance is tax-free generally, but if it's for other purposes, like here in this case, for damages, yeah, for an accident, and the insurance proceeds are greater than the cost basis of what was damaged, the excess is a gain, unless possibly in certain situations you reinvest that proceeds. So I remember doing some research in terms of getting insurance for a damaged helicopter, and because the insurance proceeds were bigger than the cost basis, there would have been a gain unless they reinvested and bought another helicopter. If you get court awarded damages, generally it is taxable unless it's for physical damages or sickness. So if you get an award for mental cruelty, yeah, taxable. For lost wages, taxable. Yeah. Otherwise, this is the only tax-free ones. Okay, that's it for chapter 3. Make sure you work on your homework assignments and email me if you have any questions.